Hello. I want to welcome you guys again, especially to another edition of our videos for this course to take you guys from total beginner into being able to place trade on your chart and being able to understand the market. So first of all, in today's topic, we're going to be talking about some basic forex terminologies. Okay, I've already listed them out here. Basic forex what trading terminology. So these are terminologies you can use in the market. There are more than this you can study, but these are the basic ones I want us to learn today. And if you want to learn more, you can as well go online. This information are there to get more insight on forex trading terminology. So, but these are the ones that we often use as forex traders. So it is good to know all of this so that when people start gisting about like forex traders, you'll be able to participate and understand what they are talking about. Okay, so number one on our list here is the market. The market. When you hear the market, what does it mean? The market. Once somebody say, "Guy, I'm going to the market to trade," the person is telling you that I'm going to trade forex in the forex market, which is the online market. It's not your conventional market where you go and buy your tomatoes and meat and all that. So the market here is where we go to buy different currency and sell different currencies. Okay, so that is the market. Then number two here is called chart. Chart. When someone say, "Oh, guy, I want to go and check my chart." So chart and the market goes hand in hand. The chart can be the market. Okay, all right. So the chart can be the market as well. So the chart. This is the chart. Let me just give you a sneak peek of the chart. This is the chart. Okay, this thing you are seeing here is the chart. This um graphical representation you are seeing here that looks confusing, all this up and down movement, blah blah blah, and all that. So this is what we call the chart. Okay. Then also something I forgot to add here, candle. Let me add it. Let me add it here. Candle. Um, I want it to be beside the chart here. So candle. You can also add this in your notes. Um, let me make it 2A, 2A, 2A candle. Sorry. Um, candle. I forgot candlestick. Candlestick. I forgot to add it here. So candlestick. So when you hear candlestick, what does it mean? Well, what does candlestick mean? So I know I'm going to explain the chart, but I want to use the candlestick to explain what the chart is all about. So what are candlestick? Candlestick are all of these things you are seeing here. It's on your MT5 as well. It's on your MT5 as well. It's on the trading view, right? So this is candlestick. Each of these things you are seeing here is candlestick. This guy here like this. One of these bar is candlestick. One of these bar like this one here is called what? A candlestick. A candlestick. One of it. Now collection of it together is what we call chart. So for me, I like to define my chart as collection of candlesticks. Multiple candlestick collection together is what we call chart. So when you look at this, you can say, okay, guy, I'm looking at Euro USD chart, I'm looking at dollar chart, I'm looking at the pounds chart. So the all of these are called chart. Don't worry, you get to understand what chart, how to use this chart, and how to understand what the chart is saying. Okay, but just for you to get a pictorial view and understanding of what the chart is and what a candlestick is. So a candlestick is a single bar, it represents price movement. So the chart is the collection of those plenty candlesticks. Hope is clear. Hope is clear. I don't want to be too fast. Okay. So this is a recorded video, but we'll give avenue for you guys to ask questions to get clarity as well. Okay. So we've settled the market, we've settled chart, we've settled candlestick. Now I'm going to be talking about what is stop loss. What is stop loss? It's very simple. Stop loss, like the name implies, stop loss. If it's an order, is an order you give to the market to say, if I'm entering a trade, if I'm entering a trade, because the trade can go in your favor and it cannot also go not go in your favor. So the stop loss here means that if I'm entering a trade, you are giving the market an order to say, okay, when the market is going against me, when the trade is going against me and it get to a certain point, please take out my trade. So let me give you an example. For instance, this line here, why is it not showing? Why is it not showing? What is wrong? Sorry, let me try and sort this out. Okay, so for instance, we'll say we're going to be entering a trade at this blue line right here, this blue line here, right? And we want the market to, go up above like this. Let me see if I can draw it out. I give you more. Where is this my part two? Where is my part two? Where are you? Sorry guys, let me look for this guy. I usually have it in my favorite, but let me see. Let's see. Where are you? Where are you? Okay, look at you here. All right, let's say we want our trade to come up like this, like so. Okay, like I was saying, so for instance, you want the market to go up like this, uh, but eventually the market starts coming down like this, start coming all the way down, start coming all the way down. Okay, but this is what you actually wanted to. You wanted to go up to come to this level here. This is what you wanted. This is what you wanted. Okay, but in the event that this does not happen, that the market wants to go to the opposite way, okay, so you put an order somewhere like this, an order somewhere here, and say once price gets to this other blue line here, please close my trade, stop my loss. Just as the name implies, that's what we call stop loss. So whenever you are trading, we use this thing called stop loss. So when somebody tells you that the market hits my stop loss, it means that the place where I set in the market for the market to stop trading, that is where the market hit and took me out of the trade. Okay. Now the not other one here on our list is called take profit. Take profit is the opposite of stop loss. Now remember, the stop loss is this other blue line at the bottom here, which is the stop loss, whereby trade is going against us. But now take profit is whereby trade is going in our favor. All right, in our favor. We'll put an order in the market that price once you get here and you touch this place, please close my trade and take my profit, keep my profit. That is the meaning of take profit. So stop loss is to please take my loss and cut it at this point and leave the market for me. I want to go out to the market. Then take profit is price. Please, if you get to this place, take the profit and close the trade out for me. Now, if you don't set any of this, the market will just do what it wants to do. It can go in your favor and go against you and keep on going, 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 and go. Okay, so it's always good and important to set your stop loss and set your take profit. So number five you're going to be talking about is lot size. Okay, lot size is very important as we go on with risk management and how to calculate your lot size and all that. Now we have a calculator to calculate your lot size. So lot size, as the name implies, lot size. It means that you are setting a particular amount aside from your account. It's okay. This is the amount I want to risk. So this lot size is what helps you to determine the amount you would want to be risking per trade in your account. So that is lot size for you. That's the meaning of lot size. As we go into practical examples, you will understand what lot sizing is all about. Then number six is what we call PIP. 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 Right? PIPs mean point in percentage. Point in percentage. Now, what's the meaning of PIPs? PIPs is the movement price makes is calculated in pips. Just as humans, if we are moving, our movement is calculated in steps. In steps. Also, a price moving is calculated in pips. Right? It can move like this. Sorry. So price can move like this. Boom. boom, boom, boom. All right. So the distance from here to here, the amount of distance from here to here is being calculated in what? In pips. So we can see price move in 1 pips, in 2 pips, in 3 pips, 5 pips, in 20 pips, in 100 pips, as the case may be. So all of these things is the distance to which the price moved in the market. Okay, we have a tool also to calculating the amount of pips that price has moved. This is the tool here. This is the ruler. You can use this to measure the amount of pips that price has moved. Okay, so don't bother yourself about that, but that is the meaning of pips. When somebody tells you, bro, my trade, I got about 20 pips on this trade, I got about 50 pips, I got about 100 pips, it's going to give you an idea what the person is talking about. He's talking about the distance that the price moved in its favor before closing out the trade. Now, we have another word here called buy. Buy. So when somebody says I'm buying in the market, buy um slash long. When somebody say I want to buy, it means that the person wants the market to go up or they want the market to go long. That is the meaning. When somebody say, bro, I want to buy, it means that this is what the person wants. I want the price to go up. I want to go long. All right. So that's the meaning of buy. It means that you want to enter the trade from here and you want the price to go all the way up. So when somebody say, I want to buy a trade or I'm going long, this is what they mean. Then also we have sell. Sell here also can also be called short. Short. Someone can say I'm selling or I'm shorting. I'm selling dollar or I'm shorting dollar. What does it mean? The person wants the dollar to come all the way down like this. Okay, so I'm shorting or I'm selling. So sell and short, buy and long is for going up, sell and short is for coming down. Okay, then we also have what we call leverage here. Now, what is leverage? Okay, let me explain number 10 before I explain number 9. Broker. Our much anticipated explanation. Broker. Now, what is a broker? A broker is a place, all right. So these are people who help us keep our money that will trade. You cannot take your money, your $100, $1,000 to the market to trade. The market is $1 trillion market. Your money has no significance. So we go to these brokers and they will give them our money. So they help us go to the market and place trade with our money. Once you link your broker to your application and they click buy or sell, so these guys help you carry out your orders in real time. So broker is synonymous to your banks you use. So we have a lot of brokers in the market where you can partner with and fund your money. This is where you put your money and start trading. Okay, so brokers are regulated just like the way banks are regulated, like CBN. Just like your bank cannot close, regulated brokers also cannot close down and run with your money. Okay, so you must go through a broker to trade. It's just like you want to transfer money, you must go through a bank to be able to transfer money from Asaba here or to Lagos, or from Lagos to Benin here or to Abuja here. Okay, so you must go through a bank to do all of those transactions. So also you need to go through a broker. So these are the guys that we use to place our trade in real time in the market. Okay, now talking about leverage. So leverage is something that the broker gives to you, that it's like a loan that the broker gives to you. If you deposit about $100, depending on the amount of leverage you selected from the broker, it means that that leverage will multiply with your money to show the actual money you're actually trading with in the market. So the broker gives you leverage because our money is not enough to trade financial market. So when you fund your money with your broker, you will now select the amount of leverage you want to be using. That's the amount of loan you want to borrow from the broker and add to your money, so that when you place a trade, your trade will make more sense. So leverage is the loan that the broker gives to you, okay, to be able to maximize your profit at the end of the day. Cool, cool. Now the next thing we're talking about is bullish. When you hear the word bullish, like it's implied bullish, bull. The name bullish comes from rather bull. The way bull, no bull with horns. That animal that has horns, okay, that run after red cloths. So that's called a bull. So if the animal wants to kill, it takes its prey with its horn and lifts it up and kill the prey. So this is how the animal kills. So the animal kills at the up. So that is called bullish. So when market is going up like this, we call it a bullish market. Like this, when market is doing something like this, it's just going up. It's just going up. It's called what? A bullish market. The upward movement of price is what we call bullish. Bullish is going up, right? Then bearish is the opposite of bullish. Bearish, your market is coming down like this, like so. So this is the bearish market because price is coming down. So when you hear bullish, just like the animal called bull, bullish. Bearish, like the animal called bear, where the bear keeps his prey on the floor and uses his both finger, pin it down and kills it. So bearish, coming down, bullish, going up. Okay. So when somebody say, bro, the market is currently bullish, it means that the market is currently going higher and higher. Somebody say the market is bearish, bro, it means that the market is coming down. So these are things that forex traders use while talking. Then also what is currency. We all know what currency is. Currency is like your USD, JPY, USD, Japanese yen. I explained this before, but we're going to be talking about more of currency in our next video. We're talking about quote currency and the base currency. I'm going to give you guys some examples of currency and how these currencies are being represented in the trading world. Now, what is called spread? Spread. This one is important as well. So spread is a commission, right, that the broker charges for you. Now, for those of us who have visited the bank, when you enter the bank, you see something like a rate board or a rate board in the bank that has something like this, that looks something like this. I'm going to try and draw it. Let me see if I can draw it. Okay. Then you have something like this. It looks like this. Rate board. For those of us in Nigeria must have seen it. So and then it's something like buy. The right buy here. Then you see sell here. Oops. I'm not able to do this thing well. Okay, so let me see if I can do it again. So uh, I've tried, I beg. So we have buy here, we have sell. Then you will add some numbers here. They'll put US dollar here. So they'll put US dollar at this point, euro, pounds, Japanese yen, all of this. So then you now see a price here that they are buying at the bank. You now see a price that they are selling. If you go to build the change, also you still see this rate board. So the price they are buying is always different from the price they are selling. Okay. So the difference between this price is what we call the spread. The difference is what we call what is spread. If you go to the market now, you want to buy dollar. If they are selling dollar, let's say, yeah, if they are selling dollar for 1,000 currently, for 1,000 naira currently, and you want to buy um um $100 worth of it, you get to spend about 100,000 naira to get $100. But if you want to sell your dollar, they will not sell to you at this 1,000. They will not come and sell to you at what? At 950. They will sell to you at 950. You know why? Because they need to make a gain. They need to make a profit as the people carrying the transaction for you, as the middleman, right? So they are the ones doing transaction for you. So this is where they make their profit. You can go and buy dollar from them at 1,000. But if they want to now sell dollar to you again, the same time, they will sell it to you at 950, right? So the 50 naira difference here is what we call spread. That is their profit. So also the broker does this too if you are placing a trade. So when you place a trade, there's always a spread in the market at the time you're placing the trade. So that spread at that particular time is what the broker takes as profit for your trade. So for every trade you take, there is a spread for it as what you pay to the broker. So these are they make their money. So this video has gotten too long already. I'm going to be cutting it short. In our next video, I'll talk about currency pairs. Bye bye.